हेलो नमस्कार दोस्तों, मैं हूं आपका मित्र विवेक बजाज, को फाउंडर स्टॉकेज और इलर मार्केट्स का। हेलो एवरीवन, वेलकम टू येट अनदर फेस टू फेस इमर्ज। दिस इज गोइंग टू बी एन इंग्लिश सेशन। दोस्तों ये इंग्लिश में होगा बिकॉज आज मेरे साथ जो गेस्ट आए हैं वो डाउन साउथ से हैं, तो इंग्लिश में ही बात होगी। तो अगर आप इंग्लिश नहीं समझते हैं तो कोई बात नहीं है, धीरे 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 सुनिएगा, बहुत रेलिवेंट डिस्कशन होने वाला है। Friends, let me first of all wish you a very happy Saraswati Puja. Today is 5th of Feb. I'm recording it today. As you can see, I'm wearing my yellow because today is a Saraswati Puja, and I sincerely wish that Ma Saraswati wishes and blesses all of you in your endeavors. Today in this face-to-face emerge, I have a person who has been blessed by Ma Saraswati. He has very good understanding of options. And he was working earlier somewhere. Now he's a full-time trader and is also helping people who want to learn by sharing his knowledge with everyone. So today we are going to take the maximum learning from him. Let me welcome for this face-to-face emerge, Mr. Reddy. Hello, Reddy.
Hello, Vivek ji. How are you?
Good, good, good. So is it okay if I use Reddy for you? Because your first name, I may make mistakes, so I'm using Reddy.
In fact, I mean, everyone calls me as a Reddy only, Vivek. So
okay, pleasure. That's a coincidence. Great. So good to connect with you. A couple of your followers, learners, they were pushing me hard to record something with you because they mentioned that you are a very generous, learning, sharing person. And I love people who are very generous about sharing learning. So thank you so much for giving your time. And, the format goes like this, that we want to know more about you, your background, what led you to join market bandwagon, and what are you doing right now? And then we straight away get into strategies. We have something very exciting with respect to options, which you are giving to us today. So let's start with you first. Tell us about you.
Yeah, so Vivek, I mean, so I'm from Chennai. So I've done my engineering from University of Madras in 2001, and then I got into the software job. And to connectivity to the markets, so I think it was around in the 2004. So the place where I used to live, so there was a small office where they used to sell some financial products like a mutual funds. So that's how I first connected something like you can invest in equities through some route. So it was, I mean, I have not done any R&D, so I was just going by whatever they were suggesting. So I started my investment journey in equity mutual funds from somewhere from 2004 or 2005, but with very small amount. So whatever the salary I was getting, portion of that, I mean, I started investing from that time. And so that's how it went. And I never got into the trading for the next probably in 5-6 years. And in 2008 I must say I'm really lucky, and still till that time I did not had a great knowledge about the market. I'm still lucky I had to do some real estate investment, so I have liquidated all these mutual fund investments and I moved it to some of the real estate investments.
Okay.
But what happened is in 2008, because I already had that something how equity works, and I also had some knowledge like people can directly invest into the stocks also. But I saw how markets can actually fall even by 60% index itself by 2018. And in office everybody was talking about that. So that was the very interesting, like I never thought, I mean, markets will fall to that extent till then. And then what was more interesting is during that phase I came to know like some of the people were making money even in falling markets. So it was a big puzzle for me, how one can make a money when the markets are falling. Okay, so then that's how the interest started, and then I just started looking. It was not a with a complete interest. But I just started looking at, I mean, how people can make the money and all in the next 2 years. And I did not had enough money because my money was into different investments. So for the next 2 years, I mean, on and off, I was just looking at the markets and other things. But in 2010, so I just thought, it was always, even though I was working, I was making a good progress in the job and all. So it was always, the markets was always sticking me. And I thought at some point of time, I need to give a shot. Okay, so it was in 2010 I just started my trading journey. So I mean, as everybody does, I did not had any proper knowledge or anything. I just opened a account with one of the broker, and those days the brokerages were also something like per lot they charge 100 rupees, 150 rupees per lot and all. So that was the scenario. So not any knowledge. So I started with the trading. I had a beginner luck for not even for a month, probably a week or so. started with the cash, and then somebody told, in futures for the same investment you can make a multiple returns. So started with the futures and options, and as everyone knows the results. So I started losing the money. So that was, 2010 was mostly started losing the money, and it's a cycle, right? So once you are losing the money, you'll get a call from somebody saying like, we'll give you a calls where you can make the money. So I gone through all that route, but sometime, in 2011 and 12, it's basically I figured out like there are some people making the money, so there must be a way. So where you need to start learning. And to be honest, Vivek, in those days, we were not, the sources for learning was very less. So we did not had a great YouTube channel or anything. And at this point of time, I also want to really heartfully, I just want to say the kind of work you are doing through the face to face, it's really great. And I really don't understand, the kind of current generation people, they understand or not, how much value it is giving. In those days, to get even a paid trainer was difficult actually. So now there is so much information available in YouTube, and whatever is coming from you has a lot of credibility, and I'm still learning so from most of the videos whatever you are sharing.
Thank you. Thank
Yeah.
you, Reddy. In fact, I'm building face to face for building a new generation altogether.
Yeah, that's really a great milestone in our Indian stock market history, Vivek, having seen the markets from last 12 years.
Thank you.
And so that's where I just started. There used to be some kind of blogs, so I started exploring like what are the trading ideas. So there people used to say that moving average, crossovers, and all that. So I just started applying super trend theories and all that. And then so the mission went on, like I started trading intraday, swing, positional, and then got into the commodity trading, high frequency trading, you name it, everything I have done. But I was not getting, I was not trading with the proper strategy. So that's how a couple of years went. So it was a make some money and then lose some money, and that's how the game was going. And 2013, I came to know that so most of the people who are making the money in the world is, at least this was the impression from my research, they are the option writers, in other words, option sellers. So that's where I started focusing more on the option strategies. And in fact, I think in those days it was tasty trades and option alpha. Some of the sources where I started learning about all these strategies and all, but I was not very clear about the adjustments and other parts and all. So but I was started going in a right path. I understood how you can hedge the positions, to avoid the overnight risk. So 2013 was kind of, I was, at least I started going in a right phase. But still, so as the markets used to be volatile, I had a mix of profits and losses. Finally in 2014, so at some point of time, I got my breakthrough. I have started forming some rules and all. So obviously, I would say, from 2014 onwards, I got my breakthrough, break even. So from there, I started slowly trading with the capital. And the best part is, Vivek, so when I was not sure about, how to trade, I used to deploy 5, 10, 15 lakhs and all. Whatever the money I used to get it. And there was a day even I lost, 4.5 lakhs in a day. Okay. It was very difficult to come out all with that phase, but luckily I also had a job and I used to get some money from there. But when I got the break even, and when I realized what is the risk involved in the stock markets, I did not had a guts to put a lot of money there. So I started with the capital like 3 lakhs, 5 lakhs, and as I was making more money and slowly increase the capital, right? So that's how my journey started. So and I switched to discount brokers like ZERODHA and other aspects. And from 2015 I was really confident. So I was really confident that I can able to make the money, but I was not confident enough to increase the capital drastically. Okay. So was working, and I was also doing the trading and all. And I have, in 2015 I also had I thought, at some point of time, I learned this with a lot of pain. So I may need to share this knowledge with someone else also. So that is when I went for a NCFM technical analysis and also the option strategies. I applied for those examinations, I got those certifications as well. And I also subscribed for the the 60-day challenge, and I won 17 times. Okay. And then so that's how the journey went. From 2018 I have increased the capital substantially, like 15-30 lakhs. And then 2019 I think it was around 40 lakhs or 50 lakhs. So And at the start of this financial year, almost I reached to a stage, probably I think almost 95 lakhs to 1 crore capital I had actually at this start of this financial year. And this financial year I also added some more capital which I got it from the sources. Currently I'm trading with a broker called FYERS. So here also again I subscribe to, they conduct something called a 30-day challenge. So I won that challenge 5 days, 5 times in a row. And there is a certification called Wizard. So this is the journey in brief. Sorry if
Awesome.
I taken more time.
No, it's a very important journey which you have mentioned, because most of the people who are new into the market, they are facing those hurdles at every stage of their journey, especially taking a decision when to leave the job, when to go all in into the market. So your journey is pretty much giving them a perspective that it is difficult to take that big decision of scaling up,
Yeah.
because you still you live in that zone for that brief period where you are still not sure, yet you're sure, and you just have to press the trigger that kind of sure, so let's go for it. So what's the before we get into strategy, tell me the year when you finally decided that enough is enough and you left your job.
Yeah. So in 2020 November, we are all hit with the COVID in March. So I
Yep.
had a luxury of working from home. So I was a senior manager in a software company. So I was in a very good position, but I was getting a very good salary as well. But I always had a dream that I should not die, working for someone else, and I need to do my own business. So these are the strong words I always had in my mind, and I had an immense passion for the trading. So there used to be a days, where I used to work on a strategy continuously for 20 hours also, and my family also used to get worried actually. But 2020 November, it was in August I made a decision, and then there was a 3 months notice period. So I've become a full-time trader from 2020 November, Vivek. And before I took that decision, so it was for a 14 months, I was able to get returns from the market that was more than my take-home salary. So that is when I got a confidence, and I had some kind of a financial cushion, and I've explained in detail to my parents and spouse and kids. So this is what I'm going to do, and then so they were slightly concerned, but I was able to probably explain it to them, and then that's how my full-time trading journey also started.
Absolutely. So, guys, बहुत important है. Just listen to this, what he has said. It took him many years to reach that stage of taking a decision. Okay. Secondly, he took 14 months of identifying whether he is able to make that much money, which is going to beat his expenditures. And also, he has kept a buffer, which is like a fund for his expenditures, right? For his livelihood, for his lifestyle. And then he took that call. And someone at a senior software level, I know these days, you whatever money you want, you can get it. There's a huge demand of software professionals. So he can actually command huge salary, but then he want to live his dream. But that's not impulsive decision. It's a well thought, well structured decision. So I think this face to face, let me divide this into two parts. One is your journey, which is answering the question, big question for everyone, that what do we do? How do we do? So this, I think you have explained very clearly, and I'm sure people who are listening to us would have understood this very clearly. And now the second part of the face to face starts, which is the strategy. So because you took options as a main occupation, because options has the inherent advantage of giving recurring income, and he's going to share with us how and how he is doing it. So let's go for it. Ready?
Sure. Yeah. Vic, are you able to see my screen? So now,
Not yet. Would you like to share it?
yeah, 1 second. So is it visible now, Vic?
Yes, it is.
All right. Okay. So what I thought was, before I explain the strategy, so I'm going to explain a very important strategy where I trade most of the times. And apart from that, so I thought I will also explain the path. How one can actually become a professional trader, and what are the things they need to do apart from just sticking to the strategy and all. So I'll probably spend some 5 to 10 minutes initially before I getting into the strategy, Vivek.
Just 1 minute, Ready.
Yeah.
I have to give a disclaimer. So, friends who are watching this, the strategy sharing is more objective is for learning. Okay. Even if you want to implement this strategy, please do your front testing, do paper trading, do your back testing, and then only put your money, because your money is your money. His knowledge is his knowledge. My initiative is my initiative, right? And we all are accountable for everything what we are doing. Secondly, I don't have any commercial relationship with Mr. Reddy. So whatever he has in offering, I don't know what products he offer or what he does. Whatever he is doing, it's his thing. And you, if you at all want to take any service from him later, it's your decision. I have nothing to do with that. I want to make this thing very clear. I'm here only for one objective, to inspire people and to train people. That's it. All right. Thank you. Thank you, Reddy. Sorry, it's an important disclaimer because these days, lot many things are happening around me. So I just thought I want to be absolutely clear about my stance.
It is, Vivek, and I totally agree with you. I'm comfortable. Right. So first and foremost, this is something very, very important. I mean, these 5 points for me as a trader, and from the psychology point of view, and this is something I tell to the many people. So once you learn the technical analysis, or I mean, whether it's optional strategies, finally, once you come to a stage, if you want to continually or consistently make the profits, it's a psychology, trading psychology is the most thing, which is, at least, I mean, I learned very important. So I'm a great fan of the author and trader Mark Douglas, so who has written books like Disciplined Trader, Trading in the Zone, and I listen to a lot of audiobooks, especially on the trading psychology. So these are the 5 points I will never be able to forget in my life. So this is something I always look at every day, right? So I just thought, I mean, I'll bring this quickly to everyone's notice. So these are the 5 fundamental truths about the trading. So we need to understand, we need to make our mind that, so these things are reality, these things can happen anytime. The first point is, anything can happen in the market. Okay, so tomorrow market can fall 20%, 10%, and you might see some pattern, which never happened in the past. So we need to be ready to face that. And you don't need to know what is going to happen next to make the money.
True.
So many people have a perception that we need to be in a position to predict the market direction in the right way, otherwise we'll not be able to make the money. No, that's not the way. So we do have some strategies, so where you can travel along with the markets and still make the money. Okay, I think most of the successful people, in a long run, after spending a lot of time in the market, they will get a wisdom like, predicting the direction of the market is near to impossible. So in long run, and then there is a random distribution between wins and losses for any given set of variables that define the edge. Okay, I'll just talk about that. So basically, if I take a simple example, and if you flip a coin for 100 times, so there is a probability that next to 5 flips will be tail, and then next one will be head.
True.
But if you flip over 1,000 times, the probability is 50-50. Okay, yeah. So if you can find out a way where you can able to predict that 52 times of 52% of the times I can able to predict well, so that's your edge. Okay, so that's what is the next point. An edge is nothing more than an indication of higher probability of one thing happening over other. Okay, so this is really important, and this is very good thing for option sellers. So that is why I'm into the option selling. So as everybody knows, I think people would have seen a lot of your episodes already, Vivek. So in option selling, you make the money when the market goes in your direction. You make the money if the market stays there. You make the money even if market slightly goes against your direction, and you will only lose. But there is a possibility of losing big if market goes completely against you. But that is where comes into the picture of risk management, hedging, and all those things, where you can able to manage your position. Okay, so you need to anything, not only the trading, you need to do some business or anything where there is an edge, right? So that's what this important point is about. And every movement in the market is unique. I think this is more or less like first point. And so sometimes we feel like these are the patterns. This pattern I am looking at, and I am trading this particular pattern, and there is no way it can go wrong. But believe me, it will go wrong sometimes. So that is where I mean, when it goes wrong, we feel like market betrayed us. It is not the market which is betraying us. So it is, I mean, we need to accept the fact every moment in the market is unique, right?
Absolutely. Amazing.
Yeah. So this, I think I will not spend much time on this slide. I mean, I think most of the people already know. So I trade only in Nifty and Bank Nifty options. And predominantly I was trading in Nifty, but nowadays I'm trading in Bank Nifty also. Simple reasons, this indices, they have a highest liquidity. In fact, I mean, Nifty and Bank Nifty are the largest traded option instruments in the world. So they have a huge liquidity, and you need relatively less margin compared to the stocks. And stock options are more volatile. Okay, they can go up by 10-15% even every day, but index cannot do like that. And there is a physical delivery of stocks even for a buyer or seller, so you have a risk of giving a physical delivery, and if you don't have a sufficient balance, you will go into all that penalties and other things. And index options are cash settled, even if they close in the money, so they are settled with the cash without any penalties. The slippage cost is very less because there is a more liquidity, and whenever you want to enter and exit, you can do it easily even with the market order. So these are the reasons I trade indices for the stock options. Now, this is one last slide. I mean, before getting into the strategy. So these are the important points. I mean, once you want to become a professional trader, so over a period of time. So first thing is, I realized, so earlier I used to trade with the cash, but when you are cash, when you are going to do a lot of investment, so for example, if you are going to start trading with the 5 lakhs or more and all, you don't need to really trade with the cash. You can actually invest this 5 lakhs into a kind of a very safe instruments like a debt funds, or if you have interest in equity, the safest ones like ETFs, Nifty Bs, Bank Bs and all, they give at least, over a long period of time, 12 to 14% returns and all. So, or mutual fund stocks. So you invest them, pledge them, and use the collateral for trading. And I'm not naming any brokers here. I mean, there are some full-time or discount brokers who give a 100% collateral facility, and you can use them. Okay.
Oh,
just
one correction. I think you can give collateral to them, but then exchanges have their haircut mechanism. So if you give liquid fund, they'll give you 90% margin against that. Just a small, I thought it's better because they don't give 100%. They will obviously do the haircut as per exchange norms.
Yeah. I mean, thanks for clarifying that, Vivek. In fact, when I say 100% collateral, it's always after the haircut. And haircut is different for different instruments as defined by NSE. Yeah.
Correct.
So, I mean, overall, you will get around 85 to 90% as a collateral amount.
Yeah.
Okay, that you can use it for trading. And you don't have, I mean, so this way, so this is, for example, if you go for a safest 5-star rating debt funds, you will still get, 5 to 6% returns, which is a, passive money. You don't need to really give. Imagine you are trading with a 50 lakhs capital, you get a 5% return out of that, which is, decent money actually. You don't need to give up. And in fact, this is something, I even tell to the people who only invest in FDs, forget about the stock market. So when you are investing in, FDs, so the post-tax returns are less, and you will lose the deferred taxation benefit. So when I say deferred taxation benefit, for example, if you are investing 1 crore in FDs, so at the end of the year, whether your FD period is completed or not, you still need to pay the tax for the assumed interest you earned over the FD.
Right.
So that means that money is not actually compounding.
Right.
Okay. Right. But when you invest in a debt funds, let's say growth funds, so if you invest for more than 3 years, you have a post-taxation rate, post-indexation benefit of 20%. After indexation, you just need to pay 20%, which is very less. But in FD, it's if you're in a 30% bracket, you will straight away pay more, and all your money is not actually compounding. So whatever the returns you are getting, that's a compounding. So just wanted to make this point.
Very, very important point. I would like you to repeat this point because not many people pay attention to this. And, over a period of 3 years, 4 years, if you do invest in debt funds, the chances of generating negative return is very less because the interest rate, short-term interest rate risk is getting nullified over a period of 3 to 4 years. Can you please repeat this once again for benefit of our learners?
Sure. So what happens is, Vivek, so when you have a capital, let's say you have a 10 lakhs capital and you invest them in a top quality debt mutual funds. And don't go by in the past, they used to give 8%, 9% long-term debt funds, but now you go with a simple calculation of 6 to 8% returns. Okay. So this 6% returns, and if you invest for a more than 3 years time, so for whatever the profits you make, you can take into the account of indexation benefit, and post indexation benefit, you have to pay 20% tax, which means mostly you will not end up paying any tax for the returns actually. But if you have invested in FD, okay, let's say you invested in FD for 10 lakhs and it is for 3 years or 4 years. But as per the income tax rules, the profit, whatever the profit you make from the FD at the end of the year, even if you do not close that FD, you still have to pay the tax. Okay, so 10 for example, for let's say you are making 5,000 or 50,000 out of 10 lakhs. So that money, for that money, if you are in 30% slab, 15,000 or 20,000 you pay as income tax. So that is not compounding. Okay, so your post tax return is first of all 3.5 percentage. Okay, and then the interest is not compounding. But whereas in debt funds, because it's a growth, whatever the returns you are generating, that is compounding. Okay, am I clear with that?
Absolutely, absolutely.
So this is, even this is a, when I come to know about all these things and all, it was a, very big positive points actually. There are people who invest only in FDs, so they can choose the alternative debt funds to get the better returns.
So I want to add this, while you were speaking about it, I was checking StockEdge mutual fund section, and I was seeing for the last 3 years, what is the typical return debt fund has given. So I saw the top ones, they have generated return of at least 8%. So just imagine an FD rate has been around 6.5% for 1 year, or 3-year FD would be probably 7% max.
Thanks.
So considering the tax advantage, which you just mentioned, it's such a powerful thing you have given, that you can generate more return using debt fund, plus the tax adjusted return will be higher, plus the compounding impact will be higher, because in FD your tax will be outgone on a yearly basis. Fantastic. Thank you so much for this. Let's go ahead.
Right. And profits from directional strategies. I mean, I'm not against the directional strategies, but when you are actually increasing your scale, making the profits from directional strategies even more very difficult. In the sense, you have to be technically, or somewhere you need to have a strong strategy, and you need to have extreme discipline to make the profits. Okay, so it is possible to make the profits from directional strategies, but it is just that you need to have a more skill, compared to the non-directional.
True.
And backtest and forward test your strategy to see if there is any edge to make the profits. Any strategy, be it intraday or positional or anything, whatever you want to trade, always just do a backtest and then do a forward testing with a small capital to get a sense of, like, is it tradable, or is it something I can apply on top of that. I'm not a great fan of backtesting, but I'll get a sense out of it and then keep improvising. Okay, and finally, coming to the some of my favorite strategies, Vivek, there is nothing like one strategy which takes care of everything. So that's not the true. So these are the strategies at least I trade. And Ironfly, nowadays I'm predominantly in Bank Nifty. So I trade weekly options because I'm a full-time trader. I trade current week options, but it can be traded in monthly options also if somebody is a job going and all. And when the VIX is more than above 14, so obviously I trade Ironfly. And whenever the VIX is less than 14, I trade diagonal Ironfly. It's a combination of calendar spreads, but I don't choose the same strikes, but it's a different strikes I choose. Diagonal Ironfly or diagonal, double diagonal calendar spreads. Right? This is basically double diagonal calendar spreads is an alternative for iron condors in a low VIX environment, which gives the better risk management. Okay. And similarly, diagonal Ironfly. And apart from that, I'm a very active expiry date trader also. So where I mostly stick to the short strangles mostly, but I mean, sometimes I also do short straddles as well, but mostly predominantly short strangles. Right. And finally, so trading is, if I have to put it in a simple words, it's all about setting the rules and then blindly following them. It's not like you do a different strategy. So with whatever the knowledge you have and wherever you have a conviction, create a set of rules or framework and then manage your risk. When I say risk, it includes, you have planning for a position sizing, when you need to do the adjustments, what is your profit targets, how you want to trial your stop loss. All this need to be crystal clear, and once you have a conviction, just follow it. So that is the trading. That's it. And to realize that, it takes a long time.
True.
And just follow these rules religiously. Trade with the logic, not with emotions. It takes time to overcome your emotions. For me also, it took long time. And even now, sometimes when I go through some emotions, but we always need to try and overcome the emotions and think from the logic, not from the emotion point of view.
True.
Now, in this, in this session, I'm going to present about one of the strategy, Vivek, which is Ironfly. So I'm going to talk about that so in detail. So probably in the next strategies, maybe sometime later.
Sure, sure.
So as I said, any strategy before we trade, it's important to have a view of how it has performed in the past.
Yeah.
Okay. So back testing will not give exact results. So these results will not, you will surely not get it in the, in real time, because it doesn't take into the account of slippages and cost and other things and all. But it still gives some perspective, like it is giving a profit. Okay, if you trade over a period of time, it gives a profit. Okay. So this ironfly, what I've done is I've back tested ironfly with the 1 year data, and the next slide has the 3 years data, both on Nifty and bank Nifty. So with the options like with the multiple combinations, like typically ironfly is something you sell the at the money call option and put option, and then you hedge them with the out of the money call option and put option. To hedge, so obviously when you are selling at the money call option and put option, so you will the delta of them is 50, and the OTM call option and put option, whatever you need to buy as a hedge, so that can be 10 delta or 15 delta or 20 delta typically. Yeah, so typically it's a 20 delta.
Okay.
So, or the other way, what people do is, when you sell a ATM call and put, let's say you are getting 1,000 rupees as a premium. So, and the market is at 39,000. Okay. So you will buy 1,000 points of a call option, which is 40,000. You will buy 1,000 points below put option, which is 38,000. Okay. So, but if you actually look into the deltas and all, so they will fall under somewhere around 20 delta. Okay.
Can I, while we discuss this on presentation, can I also request you that you look at Opstra and show us the payoff, etc., for a easier understanding of people who don't know these concepts?
Yeah, I'm going to explain all of that. Once I get into the next
oh wow, fantastic
slide.
Thank you.
Yeah. So these are the results from last 1 year. So which gave me some kind of a view, like, this strategy is profitable. And let me also just take you to the next slide, which gives almost a 3 years returns. So both from the 3 years and also from the 1 year. So both for Nifty and, Bank Nifty, if you do this ironfly strategy, this is without any adjustments. This is actually without any adjustments. So there is a possibility you can have a positive ROI. Right. But now you may ask a question like, so this itself is giving me a return of 60%, 67% annual return. And why do I need to do the adjustments, or why do I need to manage the trade? Okay. The biggest problem with the options, selling strategies, that counts even ironfly also. If you don't manage your trade. Now, for example, so ironfly generally, it will have a probability of profit is around 40 to 42%. Okay. So remaining 60% of the times, so what happens is, so it will have a mostly 1:2 risk to reward ratio. For example, let's say you have created a ironfly strategy which gives a 20,000 profit per one lot and 10,000 as a risk. Okay, if the market is in a downtrending phase continuously, or if it is too volatile, so your ironfly can make a loss for consecutive 4 to 5 weeks. Okay, which means for each trade you may have to take a 10,000. I'm giving an approximate figure, 8,000 or 10,000 loss. Right? If that happens 4 to 5 times, we are talking about the 40,000 loss. Okay, and the capital required to trade the strategies, if you don't sell any additional call options or put options, it's just a 75,000 to 1 lakh. So for imagine losing 40,000. That means 40% drawdown on a capital of 1 lakh, which is impossible to trade.
Correct.
So you will not have a mindset. You will not trade the strategy. So that is why it is very important for me, at least. The most important thing is how I can able to always manage the risk, how my screen will show the least possible MTM return. And if I'm managing my risk continuously, I know I will be able to make the profit in the long run. And I'm going to explain all that in detail in my strategy.
Sure.
Okay. Right. So now I'm getting into the actual strategy. Vivek?
Yeah. Please.
So
proceed.
now, yeah. So what I'll do is, I'll just first create a simple. In fact, I traded this strategy. Yesterday I took this ironfly strategy yesterday also. So this is one of my account. I trade in my account and my wife account. So I trade with bigger volume. So this is the live which are running from yesterday.
Okay.
Right. So let me go to Opstra. So in terms of how do you create a strategy? So ironfly can be created. So I'm choosing the Opstra. So just to track the my trades. Okay. Now option chain I'll pull out, and I am choosing, I trade in weekly options. So
Oh, you trade weekly options?
Weekly options, yeah. And I've also given some figures here, Vivek. So for example, if you are trading in the bank Nifty, so we trading, initiating the trade on Friday and closing it on next Thursday has a higher probability of success. Okay. But the
Okay.
same thing, if you want to achieve in Nifty, so if you initiate the trade 9 days before expiry, which means you should trade the week after next week. So
Okay.
you have a better probability of returns. This is from the back testing, and in fact, I mean, even in the live trading also, I have traded Nifty Friday to Thursday. It's slightly difficult to manage compared to the bank Nifty, because bank Nifty you have a volatility, but you also have a higher premiums. Nifty
True.
nowadays, especially the premium, whatever it is giving compared to the volatility, it is not giving enough cushion. So at least
Okay.
off late, yeah. Right. So what I do is. So as I mentioned, the strategy, so we sell the at the money call options and put options. So for example, in this case, so these are the ones trading with the left side ones are call options, right side ones are the put options. So 38,800 is trading with around 50 delta. And this is with a 49 delta. I just sell this one. Okay. And I prefer, so there are a couple of ways how you can trade, I mean, which I explained in the strategies, but I always prefer to go with the 20 delta as my hedge.
Okay.
So here, so this is with around 20 delta. I'm buying this as a hedge for my sold call option. And I am buying a put, which is trading with the put delta around 21.19. So whichever is close to 20. So either of this we can select actually. So probably I'll go with this one because this is close to 20. So now once we do this, so here is our iron fly. So this is not symmetrical. When we say symmetrical, both the hedges will be from the equal distance. So but going by the delta, it need not be, I mean, exactly symmetrical. So it can be 100 points, more or less, right? So now this is the plain vanilla iron fly strategy, right? So here you can see one of the advantage with iron fly is, so it gives a better risk reward ratio. So here you can see the reward is 15,000 per set, which is the maximum possible profit. Okay. And then the risk is 9,700. So which is making something like 1:1.55. The risk reward is 1:1.55. Had you initiated this strategy, I mean, at the start of Friday morning, so it would have given somewhere close to 1.8 or 1.9. So that is what I got it actually.
Okay.
Okay. And in monthlies, I think you will get a even better, slightly better risk reward ratio. Okay. The reason I prefer iron fly is, so at any point of time, risk reward ratio is very good. And even if the markets fall significantly, the maximum loss I will incur is something this one. And this we need to combine with the position sizing, which I'm going to explain it slowly. So what I mean to say is, I mean, iron condors, so it gives a probability of 85% or 80% depending on the strikes you choose. But if you look at the risk to reward ratio, it will offer probably 0.15 to 0.2. Okay. Which means the overnight exposure is very high, right?
Okay.
Now, so this is how you initiate the trade. Now I'll explain the strategy, and then I will also probably take one of the week, and I will run the strategy through a Opstra simulator, and I will choose a week where we'll get an option to exercise all the possible adjustment options.
Sure.
Okay. Again, adjustments are not a holy grail. The whole purpose of my adjustment is to manage the risk, not to essentially convert the trade into the profit. So it may come into the profit, but what is definitely possible is you can significantly reduce your maximum loss. Whatever the maximum loss you are seeing, 9,700, you can completely, even in the worst case scenario, you can completely bring it down to either profit or 500 rupees or 1,000 rupees loss. Okay. So that's a way I manage it. Okay. Now going back to the strategy. So as I said, so best risk reward ratio, probability of profit is less, but it can be improved with adjustments. So this is the important point. And position sizing. So these are the main points about the, how I trade this ironfly. And ironfly can be traded in a multiple ways, and it can be adjusted in a, or it can be managed in a different ways by different people. But this is how I do it, and this is working for me. And okay, so position sizing point of view, I allocate around 1.75 to 2 lakhs for the bank nifty, and 1.5 to 1.75 lakhs for nifty. So ideally, I mean, to sell a 50 delta call option and put option, and then hedge them with the 20 delta, you need a capital of only 75,000. But I still keep another 1 lakh as a contingency fund, because that fund is required to do the adjustments, to manage the trade. Okay, when the trade is going out of your hands. So capital allocation per one lot is around 1.75 lakhs. And the duration is, as I just showed in the, my backtesting results, you can trade 6 days to expiry, 9 days to expiry, 13 days to expiry, which means fortnightly, or 1 month to expiry. So all these time frames you can trade. I prefer 6 days to expiry in bank nifty and 9 days to expiry in nifty. Okay. And entering time is, I just give them in half an hour to 45 minutes. So after the market opens to settle down, and then I enter at around 10 a.m. Okay. And then target is 1 to 1.5%, 1 to 1.5%. Most of the times you can achieve. So this is one way. And the second thing is, once you get into the profit, you can also trial your profits. For example, you initiated ironfly, and when you see the profit of, let's say, 1.5%, you are seeing a 1% profit, and the spot is exactly in the middle of ironfly. So you can take some chance and trial your profits. For example, per set, if you are making a 2,000 profit, Vivek, so what you can do is, you can set it like, trial your profits by 1,000 rupees. So if my profit becomes 2,000 to 3,000, so my trailing stop loss would be 2,000. So that way also you can trial. Okay, these are different ways depending on how your market is behaving at that time. Okay, and then my maximum stop loss is 2.5% per week. With after doing all the adjustments, if I'm hitting this 2.5%, I'll just close the trade and move on to the next week. And this happens very, very rarely if you are managing your ironfly with the rules. I mean, whatever I'm going to tell now. And initiate the strategy by selling a call and put option I just showed you, and buy the hedges at 20 delta. So this is something we saw. And one can also initiate the trade with the 50 and 10 delta, but make sure you to bring the hedges to 20 delta by end of the day. Or if underlying moves 30%, I'll just make it simple for you. What I'm trying to say is, when you initiate the strategy on Friday, okay, if you are buying the hedges using the 20 delta, even if the market is consolidating, the hedges also lose the significant value because of the theta decay. Okay, some people do not like it, right? So in that case, what you can do is, you can actually buy the 10 delta hedges instead of 20 delta. So your hedging cost is less, and the amount of theta decay compared to your sold positions will be less, right? Ride on that profits if that is going in your favor on that day. But before end of the day, before you're carrying the positions to overnight, make sure you bring it to the 20 delta, so that your risk is not too much. So your risk is limited, right? Or you initiated the trade with 50 to 10 delta, okay? And suddenly there is a move, okay? Suddenly there is a move in the underlying. And if that move, I put some rule actually. So all these are different rules. If your spot moves 30% towards your break-even point, okay? When I say break-even point, I think I showed you here. So whenever you create the strategy here, so you have a max profit and loss, and apart from that, you will understand this break-even points. So for this, the upper break-even point is 39,408. Lower break-even point is 38,192, which means above this or below this, you will start making a loss. I mean, if the underlying is going to close above this and below this on the day of expiry. Okay, but during this journey, even before hitting there, you will make a loss, because that is where this blue line, so which talks about the current day profit and loss, right? So this is with a 50 and 20 delta. Imagine if you have created this with a 50 and 10 delta, your max profit will be high, but the max loss also will be higher. So if you are creating this strategy with a 50 and 10 delta, so make sure either you bring the hedges close to the 20 delta, right? Or if this spot moves 30% towards, 30% towards your break-even point, you make sure you bring your hedges closer. The whole point is, yes, go and take the advantage of less theta decay. But if there is a move in one direction or before carrying the positions overnight, make sure your risk manage is controlled. Am I clear with that, Vivek?
Yeah. So basically, we are saying that let's go back to that
Yeah.
payoff.
Yeah.
So 39408 minus 30%. So if the spot price comes to that level, then you need to act. Correct? That's what you're saying?
Yeah. In terms of hedges, when stock price goes from, let's say when the market is at now 38,800. So, and the break even point is 39,400. From here, if it moves 30% towards my break even point, I need to tighten my hedges.
30% from spot.
From spot, yeah.
You're not saying 30% from the range. It's 30% from the spot. Okay.
Yeah,
fair
from
enough.
30% from the spot to break even point. And I have a calculator. I'll show you. So with the values, I have created a simple calculator how you can able to calculate that.
So basically, you are saying that if the spot price moves 30%
towards break even.
I mean, it could be either this side or that side.
That side, yes.
So if it's moved 30%, then you act. That's what you're saying.
Yes. Yeah.
30% bank nifty movement.
No, it's not underlying. So that's what I'm saying. So let me explain that to you with this example.
Maybe I didn't pay attention. Yeah. Can you repeat?
So this one, this is the simple calculator I use. So let's say, this is the position I have taken yesterday. So market was at 39,000. Okay. And I got my break even point 39,688 on the downside. Sorry, on the upside. On the downside, it's a 38,312.
Yeah.
Okay. The distance between my spot and break even point is 681 points.
Okay. So you're saying 681 ka 30%.
Yes. So the 30% of 681 is what I meant actually. So, and I will add that to my spot. So for example, now if my spot moves from 39,000 to 39,200, okay, I need to do my first adjustment for hedges. If you are, this is also applicable if you are actually initiating the strategy with 50 and 10 delta combination.
Got it.
Okay. I prefer 50 and 20 delta itself. So I don't need to do any adjustments until my spot goes towards 60% towards my break even. Okay. That's something I'm going to explain.
Got you.
Okay. Now, okay. So this is the option. So what I prefer is 50 and 20 delta, combination of iron fly. So there are number of ways how you can manage the iron fly. So I will cover, what are the best ways I will, how I manage it. And no strategy works in all market conditions. This is very, very important. So this, for example, if the market is completely going in one direction, so it may not work. So in those, the iron fly is ideally meant for high, high wicks, in generally high wicks and sideways range of a market. But we don't know, when the markets will be sideways, and we don't know when the markets will move significantly. But things like, last couple of months, you have a budget approaching and the market was extremely volatile. So those are the periods probably you can stop for, some time. So, and then go for a different strategies. So this is not a holy grail, but what I really want to emphasize here is any adjustment, whatever I'm going to explain. So understand the logic behind it, and then see if that logic makes any sense, and then try and apply if that really makes a sense.
Sure.
Now this is the strategy, and then now I'm going to talk about the adjustments. So I'll quickly cover the adjustments, and then straight away I'll jump into the simulator to show how these adjustments can be done.
Absolutely. Yeah.
Okay. So again, I want to repeat here, my objective of adjustments is mainly to keep the risk and MTM loss minimal, and continue to reduce my risk in the direction of tested side. Okay. If market is testing me on the call side, if there is a big move on the upside, I will continue to reduce my probable maximum loss on the tested side. Okay. How I do that? By selling some options on the untested side, which I'm going to explain. Right. And first adjustment, when underlying spot moves 60% towards my break-even point. So I initiate a strategy unless until my spot moves 60% towards my break-even point. So which is what I just explained how to calculate. I will not do anything with the strategy. Okay. It may happen same day, or it may happen on the next day, or it may not happen also sometimes. Okay. And so this is, what do I do? When the when it moves to the 60%, right? So let me just move this. Okay. Right. So when look at overall positional delta.
Actually,
Okay.
the problem is that in the slide, sorry to interrupt in the middle, when you say underlying spot moves 60%, it is not 60%, is not the 60% of spot. It's a 60% of difference between spot and the break-even point.
Correct. That's correct. Yeah. Vivek. So yeah. So basically, yeah, from current point to the break-even point, there is a 60% move.
Yeah.
Yeah, that's it. Yeah.
60% of the break of
Yeah.
the difference between spot and the break-even point. So that
That's
that
the
actually added confusion to me, but now it is clarified. I just wanted to clarify for other people also if they are very
yes.
confused. Yeah.
Yeah. So 60% of that, of the break-even
Yeah.
point, the difference between the spot and break-even
You're
point.
right. Right.
Yeah. So when that happens, look at the overall positional delta, overall position delta. So when you created the strategy, it's a delta neutral. Okay, 50-50 negated and 20-20 negated, it's a delta neutral, right? So I'll show you in the upstream also. So look at the overall position delta. For example, if it is, yeah, if it has a, I mean, after moving the 60%, if the delta is, there is imbalance in delta by 10, right? So for example, let's say when market moved upside, right? Now there is a delta difference of 10. Now what I will do is I will go on the put side. So whichever, if the market is going upside, it's a tested side, and other side is the untested side.
Hmm.
If calls are testing me, so what I do is I look at the overall positional delta. If the delta difference is 10, I will go and find out the same delta on the another side.
Hmm.
Okay,
Hmm.
put side. So for example, if the delta difference is 10, so I will choose a put option which is trading with a 10 or below delta. So
Hmm.
10 or 9. So I will not go over it. I prefer slightly one delta below that, right?
Hmm.
And then sell that. So basically by doing that, you will neutralize the delta.
Hmm.
Okay, why we are doing this? If market continues to go in the same direction, you will not get the incremental loss, and the risk on the maximum, risk on the tested side is reduced because you sold the additional put option.
Hmm.
Okay, right? So
Hmm.
then now what are the next steps? So market may not stop. Sometimes it can go in the same direction even by 2000 points also.
Hmm.
So by when you do this, I mean, this is just a word of a caution. So buy deep OTM options as a overnight hedge around 3:20 p.m. to protect the
Hmm.
any black swan event. So what
Hmm.
happens is, I mean, when I'm selling a additional option which is a naked, right?
Hmm.
So
Hmm.
at any point of time, it is not. I mean, especially if it is a put option, it is not a good idea to leave that as a naked option. So what I say is, so I mean, we need to take into the account of a black swan event which may happen once in a 10 years or 15 years, right? So if that black swan event happens, when I say black swan event, if the index bank nifty itself is opens by 20% is next day, I shouldn't be losing my entire capital.
And
Right.
also, if you sell naked put, obviously your capital requirement goes up. So once you buy, your capital requirement also, you get the margin benefit, right?
Absolutely, Vivek. So that's why, I mean, if you don't buy a deep OTM options, you still need, I mean, 2 lakhs or something. But if
Yeah.
you buy even for example, for Bank Nifty, deep OTM options, which is 2000 or 2500 points away, your
Hmm.
capital requirement will be, including the additional options sold, it will be, I think it will come down around to 1.3 to 1.5 lakhs.
Hmm. Hmm.
Okay. So you can buy this, 2000 or 2500 points away OTM hedge. You can buy at 320 and next day morning you can close at 920. And believe me, this is a very insignificant cost. Most of the times, you will get a same price,
Hmm.
right? Uh, right. So this is to hedge, not to take unlimited risk for the additional option you sold. And if
Hmm.
underlying spot continues to move in tested side, then
Hmm.
initiate the second adjustment
Hmm.
when either break-even point is hit. We know the break-even points. So these are the
Hmm.
break-even points. First, we are doing the adjustment when 60% level. My
Hmm.
next adjustment is if the spot continues and hits my break-even point,
Hmm.
I will do my next adjustments. So what do? I roll up my put option. So in this example, if market is continuing to go up, okay,
Hmm.
my
Hmm.
calls are testing. I already sold one additional put option. I'll
Hmm.
close that and roll up. So roll up to what level? So when I'm rolling up again, I look at what is the delta difference. Okay. Now if again have a delta difference of let's say 15, I'll choose a put option which is trading with a 15 delta and sell that.
Hmm.
Okay. So here there are two rules. Either the spot should hit my break even option to initiate my second adjustment, or
Hmm.
whatever the premium, additional put option I sold, that should lose a more than 50% of its value. Okay, if I sold it for 80 rupees, it should come down to 40 rupees. Okay, so when that happens, again I'll look at overall delta and then roll up. So this is basically to, I mean, when your additional sold option, if it loses significant value, then the additional theta decay in that will be very less. So we need to roll up, right? So, and then roll up or down. I mean, basically, continue to manage the same way if the spot continues to go in the same direction. For example, if market continues to go up in the same direction, keep looking at the overall position delta, keep rolling up. Okay, this is possible only up to one extent. So I'm telling you real life, practical cases. So sometimes what happens is, if the market moves very fast, either on the upside or downside, what happens is when short covering triggers. Okay, all the people who ever shorted the calls, they will start squaring off the positions. So this will, result into the IV expansion. All the implied volatilities, implied volatility, it will expand. So the call options will shoot up. The same thing happens on the put options also. If the markets is falling very fast, so there will be incremental loss. So during those times, when the IVs are rising or when the VIX is rising, even if you sell the OTM call options or put options, on the untested side, they will not fall significantly, because the effect of IV, the effect of IV raising, effect of IV VIX raising is more on the OTM options, because they carry the higher IV. So during that times, what you need to do is you need to manage your risk. Okay, if you're not able to reduce the losses by selling additional call options or rolling them, you bring the hedges inside. Okay, in this case, market is going upside, you already have a hedge for your call option, right? So if the market is going fast, very fast, and even beyond the break-even point, you bring the hedges inside. Okay, for that also I have defined one rule, Vivek ji. So here, this is where I'm talking about. If additional options sold do not lose premium, or if it hardly loses any premium due to IV expansion, and if MTM loss is increasing significantly, okay, or if spot hits the tested side hedge. Okay, so far we are talking about the tested side break-even point. Okay, now I'm talking about the tested side hedge. So what is the tested side hedge? In this example, so my tested side hedge is, okay, I sold a 38,800 call option. My tested side hedge is 39,700. Okay, so this hedge, if spot hits even 39,700, okay, then what I need to do is, there is no point in just managing by selling a call options or put options on the opposite, untested side. I will bring my hedges inside. So what I do is, in this example, so I will square off, this hedge will be in the profit. I will actually book the profit in 39,700 and then bring this inside to the break-even point, which means I'll square off this 39,700 call option, and my break-even is 39,400. So I will buy a 39,400 call option. Yes, I'm paying higher hedging cost, but it will reduce my risk significantly, which I'm going to show you in the simulator.
I think you should show one example in simulator.
Yes, yeah. I will show you. Right. So all I'm saying is, you can only control your losses only to an extent by selling options in the untested side. So beyond a point, you need to play with your hedges also, tested side hedges.
Okay.
Now do a sense check. So generally, what happens is, around 3:15, I do some kind of a sense check. If your position is delta mismatching, or if it is very close to your break-even point, so then just do a adjustment to make it as a delta neutral. So this is the ongoing adjustment, and then keep MTM loss always less than 2.5%. Anyway, 2.5%, as I told you. Now, for example, the overall capital required for the strategy is, let's say, 2 lakhs. So 2.5% is 5,000 is the maximum loss you can afford. Okay, so I always make a focus that my losses are not going beyond 2.5%. Okay, so now it comes the interesting point, right? So I'm talking about all these things because when I'm explaining, so it will be more clear. So generally, what happens is, people who trade the iron fly, so when the market is going upside, they will sell the put options. But the biggest question comes, what if market reverses? If market reverses, the additional sold, I mean, whatever the options you sold, they start making a loss. So when you need to exit from them, so how you can able to manage that? So this is the most difficult part, Vivekji.
Mm.
So for that, I mean, I have set 4 rules. Okay. Let's say the market is going up, you sold some additional put option, right? So if the market is reversing, so what you need to do with that additional put option? Okay. So in general, when the market goes up in one direction, and if it is coming back to your center of the iron fly, or when it gets into your green zone of your iron fly within the break even point, it will mostly give a profit. It will give a profit, and then only it will go into the loss stage, unless markets falls in just suddenly in the matter of 15 minutes, or I mean 1 hour, right? So because when the market went up on a call side, the premiums have increased like anything. Now when market comes back, those premiums will cool down. Okay, it will give you a chance for you to book the profit and get out of the trade. So but we need to have some rules around it. So these are the 4 rules I have mentioned when you need to get rid of the additional put option or call option you sold.
Can I request you, can you show a simulator, because this thing is getting slightly complicated, although you are trying to make it simplify by defining the rules.
Yeah,
Can we see a simulation?
I'll straight away go to simulator
Yeah.
then. Yeah.
Yeah.
So I'm going to the option simulator in Opstra. So I'm choosing a week which is a 28th October expiry. So where there was a very violent moves in Bank Nifty. So it shot up in almost 1500 points, and then after a couple of days, it had a big fall and other things. So again, I'm choosing this week because it gives me opportunity to test, show all the possible adjustments in Ironfly. Okay. Now 28th October is my expiry, and I choose the Friday before that, which comes to 22nd. So I'm starting from 22nd. So this is my expiry, right? So I choose on 28th October expiry. And as I said, I initiate the strategy around 10 o'clock. So let me move to the 10 o'clock. So I'll get an option chain. So let me change it to Bank Nifty. So we are looking at the, as per the strategy, I need to sell options with a 50 delta. Right?
Yeah.
So this is 28th October and 22nd October is the Friday. Bank Nifty. Yeah. So I'm just double checking. Right. So here we have, so this particular option, 40,300. So this is trading with the 52 delta and 48, which is close to the 50. This I'm selling. And then options I'll buy, which is close to, I mean, so basically, I mean, are close to 20 delta. So this is somewhere close to the 20 delta.
Mm.
And put side also close to 20 delta, which is this one. So this is my iron fly. Okay. Now what I do is, as soon as I create this, I'll see, I mean, where my spot is. So which is at 40,303. So 40,303 is where the spot is. And my break even on the higher side is 40,919. and break even on the downside is 39,681. Okay, so this gives me what is the range. I mean, when I have to do the adjustments and all. So because I've initiated the strategy with the 50 and 20 delta combination, I'm not doing, I mean, we can ignore this particular column. So break even by 30. So I'm only focusing on the break even by 60. So now as per the strategy, I need to initiate my first adjustments only when spot moves to 40,673 or 39,930.
Sure.
Okay, now I'll just move the, make it as a full screen, and I'll just move it by probably 15 minutes. Vivek, sorry,
Yeah.
I mean, one small correction. So I normally initiate the strategy at 9:20.
Yeah.
Sorry, 10 o'clock. So I wrongly initiated at 9:20. So 9:20 is the opening time in which I never initiate.
Sure. No
So
problem.
sorry, I missed that.
Sure.
Just a couple of minutes. So what happened is, I mean, when I changed from Nifty to Bank Nifty, it got reset.
Yeah.
Right. So I mean, it's the same strike, but the premiums will change. So 40,300. So this is close to 20 delta. The hedge I'm buying, call option hedge. Put side, this is the one I'm buying, which is close to 20 delta. So my iron fly is created. Okay, now it is more like a symmetrical iron fly. So both side wings are at an equal distance. And now 40,248. Let's say, I mean, 40,250 is my spot value. So 40,250 is my spot value. And my break-even points are 4886 and 39,714. Okay, now so the distance between the spot and the break-even point is 636 on the upside and 536 points on the downside. Right. So I will not do any adjustments until either spot becomes 4632 or 39,928. So these are the values we just need to remember. So let me just now start doing the testing. Okay, so I'm moving by 15 minutes. So we can see the spot price changing here. Okay, so there is no big change. So market is still around there. Okay, so still no change. And 40,632 is the value on the upside. So still we have not got to that point. 4368, 4415, 4389. So this day more or less going a sideways. So just keep moving forward. And so it's almost 245. There is no big change. So Ironfly is making around, I mean, 363 rupees profit in one lot. Okay. So it's a 330, and we are moving to the next day. So here we'll see. Yeah. So straight away, market, there is a big upside move. Okay. Now it has crossed even our break-even point. So our break-even point is 4632. Now it is at a 4726. Okay. So now what we need to do? So as the strategy is testing us on the call side, we need to sell as per the rules, we need to sell the put option. Okay. So how do we decide, I mean, what strike to sell? So I will look at the overall positional delta. Okay. If you could see, the overall positional delta is 17 here. Okay. So now what I do is, so as I'm being tested on the call side, I'll go and choose a put option which is trading with a delta of 17 or less. So I'm going to the option chain. So put option delta is, so this one is trading with a 17, this one is trading with a 15, right? As I told you, when I always select a one delta slightly less than that, because in case if market reverse, it gives me a comfort. So I'm selling this option. Right. So now after selling this, if you look at the payoff diagram, now earlier the maximum risk on the tested side was, I think it was around 7,000 or 8,000. Now it has come down to 5,700. So my focus is when I'm being tested on the call side, I need to continue to reduce my risk on the tested side. So now my maximum loss has come down. Now I'll continue to do that. So as per my rules, my next adjustment will happen when either this particular option, whatever I sold you, for 82 rupees, loses 50% of the value, or when spot hits my break-even point itself.
Sure.
So my break-even point is 48.86. So these are the rules, Vivekji.
Not the main new break-even point?
Not to the new break-even point.
Okay.
So anyway, so we added 80 rupees. So it's additional 80 rupees window we'll get it, but I'll stick to the original break-even points itself.
Sure.
Okay. So now I'm moving. Sorry, 886. Okay, 48.86, which is 40,900. So here we have hit the 40,900. So my break-even point is 40,886. Now the spot has come to 40,914, Vivekji. Okay. So now what I need to do? So one of my condition met. So now it has hit my break-even point, right? So what I do is, I'll just close this. And then I need to roll over. So I sold 39,700. Probably I need to bring it close to the spot. So first I do is, I'll just book the profit. It's a small profit in this particular option. So as you could see, current price is 75.5. I'm closing this. And now if I look at my Greeks, so there is a difference of delta there is a difference of 18.7. Okay. Now I need to go and again choose the put option, which is trading with 18 delta. Okay. So this one is just below the 18. So 17 delta. Now I'll sell this. Okay. So after selling this, now if I look at my payoff diagram, my risk has further come down to 5,100. Okay. Now my next set of rule, as I explained in the strategy, is if market continues to go in the same direction, okay, in a tested side, so I will wait for either I need to bring my hedges inside, or I need to roll up my put option. Okay. When I need to bring my hedges inside, when it hits my when the spot hits the strike where my hedge is standing. So my hedge is at 41,200. Okay. Suppose if spot goes to 41,200, then I need to do my next adjustment. So I'm just moving. So currently it's making a loss of 1,700 per set. So which is still, if you compare with the 1.75 2 lakhs capital, it's less than 1%. Okay, still it's moving, and this is also not losing 50% of its value. Okay, this is, I sold it at 98 rupees, right? So unless it loses the 50% of its premium, I'm not going to do anything adjustment. Either spot should hit this or they should lose by 50%. Okay, so here the spot has touched 41,250. In fact, it's crossed our strike price. and loss is also 2,400. It's still, I mean, 1.25% or something actually, right? So here what I do is, now I get a sense like market is completely going in one direction. So here, rather than focusing more on the profits, I should focus more on reducing my maximum loss. So this is where I do the aggressive adjustment of bringing the hedges inside. Okay, first this 41,200 I'm closing, right? So 41,200 is currently trading at 394 rupees, Vivek ji. So 394, I'm closing it. Okay. Now what is the next strike I need to buy? So how much I need to bring inside? So my rule is I need to bring the hedge inside to the original break-even point. My original break-even point is 4886. We can say 4900. Right. So I'll go and buy the 40,900 call option. Okay. No, I'm buying.
No, not for this 4,800.
40,900. Yeah. Fat fingers, maybe. Right. So one important point here I want to mention, Vivek ji. So I think whenever we are bringing the hedges inside, many people think that our hedging cost is increasing. Okay. So in this case, it's very important point. So 41,900. So 41,200 is the call option I sold. Okay. And then I'm buying a 40,900. If you look at the difference between them, I'm using the calculator because it's important. So it breaks the myth. So the difference, I mean, the difference between these two strikes is 300 points. Okay. And the difference between the premium is 567. Okay. Minus 394. Okay. So you are paying a higher, I mean, additional premium of 173. Okay. The strike width is 300 points, which means if I deduct this by 300 point strike width, so 127 points. So by bringing this hedge inside, so you are actually reducing your loss by 127 points. If I convert that 127 points with a one lot, so reducing the loss, maximum loss by 3,175. Okay. So what is the purpose of Ironfly? So we initiated Ironfly thinking that, I mean, it will be somewhere in the range. So it has broken your break-even point. It has even crossing your hedges also. So this is the time you need to focus more on reducing the maximum losses. So earlier our maximum loss was 5,100. So if by doing this, you are reducing the maximum loss significantly by additional 3,000 rupees. Okay. So you can't do this by just selling the OTM put options or call options. Now I'll show you the payoff diagram. So now if you see, my maximum loss, maximum amount I can lose on the tested side is come down to 2,000 rupees, 10 rupees. I mean, which is 1% of my portfolio. Okay. Now I'll just move on. So now what is my next rule? If the market comes back, I need to manage the additional put I sold. Okay. Or if market continues to go up, if market continues to go on the tested side, I will look at when this particular put option is losing 50% of its value. Okay. These are the rules, Vivek ji. So these can be changed, but I mean, one should have a rules.
Correct. Right. Can you show me the Greek view of this?
Yeah, sure.
What is the net delta?
It's almost, it's 8 delta additionally.
So what do I do with this?
No, we don't need to do anything because we are currently the spot price is much away from the spot, right? And if the market comes back, so the blue line in Opstra, let me tell you with my experience. So though it shows it's a sharp decline, so it actually means Opstra, with the respect to the blue line, it will not show accurately. Okay. So if it comes down, it will come into the profit and then only it will go into the loss.
Okay.
Right. Or at least, I mean, if it's not in a profits, the losses will come down. Okay.
No, but
So
your
now,
delta positive, your 8 share delta positive. So if price goes down immediately, then obviously you will lose money, right?
so that is where we'll manage this particular option.
Oh, sure. Got it.
So I'll get rid of this particular option. And
Got it.
when
Got
we
it.
have to get rid of that, I mean, I have set 4 rules. So I'm going to talk.
Sure.
Okay. Now, see if that is a, I mean, I'm just going to give, if this is a concern. So even what we can do is, instead of buying a 40,900, you can buy a 41. One strike above. So for
Okay.
example, 41,000. If you want to make it perfectly delta neutral,
Sure. Sure.
nothing problem. So that also works.
Sure.
Okay. Now I'm just moving forward. So just to this is the 98 rupees. I sold it for 98 rupees, right?
Mm.
So let's say just round figure of 100 rupees. So 100 into 25 is 2,500. So divided by 2, 50%. When I said to 50%, unless until it gives me a 1,250 rupees profit, I am not going to close this. Or if market reverse, if it gives me a double loss, in the sense, I mean, if this option becomes triple, now for example, 100 becomes 300, I'll get a loss of 5,000. My rule is for reversal, if this either becomes a triple or if it becomes a 50%, I will do a next adjustment. Otherwise, I will not do. Clear, Vivekji?
Okay.
Okay, now I'm just moving forward. So the losses.
How can a normal person do so many adjustments?
No, this is I'm doing it almost, I do this every week, and it is not difficult at all. So one of the biggest advantages, we have a hedges in place. Had it been a naked strategy, the MTM swing will be too high.
Okay.
So, and when you have a high IV expansion, Vivekji, so the call option, the hedges IV will be higher than the option, whatever you sold. So that way your hedges also moving very fast.
Sure.
Okay. And we are talking about the scenario where the Bank Nifty already moved, you can see even for 1,200 to 1,500 points. And this doesn't happen every time. And I'm taking a very odd example, toughest example. Okay. So now the losses, it's showing as a 3,300. Sometimes, Opstra, when the options become in the money, so deep in the money, so it picks up, different values. But anyway, we know that the maximum possible loss on the higher side is 2,000 rupees, and it is currently showing a loss of 3,300 MTM loss, right? I'm just moving forward. So market is continuing to go 41,543, which is almost like a, more than 1,250 points. Okay, so this is not giving me a 12,250 rupees profit. So until I will be keep moving. And one more thing is, 25th, we are on a 25th. So 28th is the expiry. I still have 3 more days. Okay. So as the market is consolidating, so you can see that, there is a IVs are getting cool off. So the losses are reducing. So we are coming to the end of this day as well. Still, this is not giving me a profit of 12,250. So I'm still moving. I'm not doing anything there. Okay. So it's almost a 330. Okay. It has given a profit of 1341. So I can do that, but I can go back to 5 minutes and do that. I can do it next day also. Right. And my losses has come down to 1,400. So that's important. I'm just moving to the next day. So now it is in a profit of 1,600. Okay, this additional put option I sold. So now what I do is at this stage, so see, it lost more than 50%. The probability of losing this more to manage my position will be less. So what I do is I'll close this position. So this is trading at 34.65 now. Okay, and now look at my Greeks. So this shows the Greeks difference of around 9.
Right.
Okay, so I'll go and choose a put option which is trading with the delta of 9 or less, right? So either of, I mean, problem in this or this is trading with that one. So I mean, I always choose same or less than that. So I'll go with the this 8.37 delta. Okay. Now my payoff is, so my maximum loss has come down to 1,890. Okay. Now this rule is same, Vivek. So here I sold 40 rupees option. Okay. So 40 rupees is the premium I sold, which means 40 into 25, 1,000 rupees. Either I should get a 500 rupees profit from this, or it should give me a loss of, 2,000 rupees. So then only I'll do the adjustment. So I'm just moving forward. So we are just, probably 2 days ahead. So my loss is slowly coming down. So let me also show the screen. I need to have a visibility of this value. Okay. So I'm just running. So market is still continuing to go up. Okay. So this started making loss, but losses is not, this started making a loss, but this has not become triple. Okay. If this becomes triple, it will show a loss of 2,000 rupees. So I'm just keep moving forward. So nothing much happened on this day, but consolidation means, so the losses will come down. So almost 215, 230. So 300 rupees profit, but I'm looking for a 500 rupees profit in that. So which has not come today. Okay, so next day, so still this is making a 361 profit, but I need a 500 rupees profit at least from that. So it's a 40 rupees, right? 40 into 25, yeah. So still moving close to that. We are just 1 day before expiry. So here, this has lost 50% of its value, Vivek. So now what I do is, and I'll just close that. So we can look at the Greeks also. So I can just close that for 18 rupees 75 paise. Okay. And look at the delta difference. Now there is a delta difference of 14. So I'll go and choose that delta which is less than 14. So probably this one, 40,500. So probably this would be the last adjustment, maybe. So now, if you look at my maximum loss, 1,200. Okay, so I'm managing my risk here. So all I can do is maximum 1,200. Now, so now I sold it for 44 rupees. This I sold it for almost 44 rupees. So 44 into 25 is 1,100. So either it should become 2,200 or it should come down by 550. So that is where I'm going to do any management there. And if you look at my maximum potential profit, it's still 8,700. So the market is consolidating. right? Still it has not come to my target. So suddenly it started giving a loss, so that means, I mean, market started coming down. But if you see, the loss has come down from 1200 to 345. Okay. Okay, so we are at the end of Wednesday. So the strategy is slightly into green. Okay, though this is making a loss, but this is not making a loss enough where I need to take some action. Okay, so the next day, straight away at open, so market slightly came down. Okay, so it is giving me a profit of 1800. Okay, this is one chance. So when we say, I mean, 1800, so if your total capital is 1.75 lakhs, so it is giving you a profit of 1% return. So this is one particular point where you can take an exit. So this is where, I mean, we have come to, I mean, almost end of the strategy, Vivek. So this is what I was explaining. So there are 4 points I have mentioned very importantly when you need to get rid of your additional put option sold. So if you don't take care of that, it can wipe out all your profits. Okay, so these are my rules. You can, I mean, one can look at their own rules. So when I will do is, so this I sold at 43 rupees, 44 rupees. Now it is giving me a 1300 rupees loss, this particular option. But my overall strategy is in 1800. Okay, so now it's not a pain point for me. So there are 4 rules I have defined. When additional option, whatever you sold, if that starts giving loss to overall strategy. Okay, for example, now it is in 1800 profit. Now, if this option value becomes so high, and if it starts giving a loss to my strategy, let's say, I mean, from 1800 it comes down to even 500 rupees, even, you know, break even of 0, then that is where, I mean, that is one point. Okay, where I need to get rid of this put. Okay, this is one subjective, but the next 3 points will be very crystal clear. When underlying spot comes to the center of iron fly, okay, whenever iron fly goes out of your range, if the spot is coming to the center of your iron fly, so when I say center, we have initiated it 40,300. If it comes to that, that is the best point to close the strategy, because you will be in a profit. Okay, so second point is that. The third rule is when premium of additional options sold becomes triple. Okay, the main purpose of selling this option is to manage that. But if this starts giving me a multiple loss at some point of time, you need to get rid of it. My rule is, if this becomes triple, I'll close that.
Close all the positions?
No, not close all the positions. Close only this particular position. Okay. And no, because by the time that, so this would have come into the center.
Yeah.
Okay, it won't come into the, you know, it won't become triple easily.
So even if I close this position, my delta will be open. So do I need to again reinitiate some other strike price?
Depending on the move. If you get the move again on the, you know, upside, you have to again sell the put option.
Sure.
Okay, the point is, if you don't do that, and if market continues to go down, then you will make a bigger loss. Okay, and the last is when additional option sold becomes in the money. Okay, now whatever the option we sold is 40,500. Okay, and we initiated at 40,300. If Bank Nifty comes back and becomes in the money, I mean, if it hits the, you know, 40,500, if any of these 4 criteria is made, I'll close this option. Now this is these 4 rules I have defined after running the strategy for so many months, Vivek, and so many hours of backtesting also.
Got it.
Right?
It's actually quite impressive. I mean, these rules are defined after so much experience.
Yeah,
and complicated. But
and when I've done the backtesting also, I never looked at the chart, because, I mean, when you look at the chart, you will get a bias.
Yeah.
So most of the weeks, I mean, I just picked up, right? So now see, as per our profit target, it is already in a 1% profit, but let's move and see, I mean, how and what happens. So now it is giving a 1,700 rupees loss. Okay, but still it has not become triple. So to become triple, it should become 2,200 and above.
Yeah.
So now if you see, it has suddenly, I mean, there was a big downside move. Okay, this is what happens in the reality. I mean, market, this is what happens in the reality. So this has given a big loss of, I'm moving by 15 minutes, but probably if I move by 5 minutes, so I may be able to take some action before that, but let's, even go with this. So at this point of time, it is giving me a loss, and it is actually doing a damage for my overall strategy.
Yeah, yeah,
Right?
yeah.
So this is where I need to take some action on this. So I'll close this. So this is now trading at a price of 196 approximately. So I'm taking loss on that. So 2,200 is the loss I was supposed to take, but I'm taking much bigger loss on that. Almost double. Right now, the payoff is like this. Okay, but now we are in a green zone and we are on expiry day. Okay, on expiry day, there are multiple ways how we can manage, but I'll still go with these rules. Right. So I'm just moving now. So market already gave us a chance to exit with the profit. Now I'm still moving. So 1,300 profit. So now if you see,
square up.
So I normally try to square off around 230. So around 230. I mean, because beyond that we'll get a gamma risk.
Sure.
But if I want to hold my position beyond 230, I'll bring my hedges so close, Vivekji.
Sorry, Reddy, we need to close this because I have a call lined up.
Yeah.
So let's wrap up this.
Yeah, I'm just closing this. So now it is at the center, Vivekji. So 1,900. It is still giving a 1% profit. Okay, so this is the again point you can make a. So here we are almost getting 1.5% return, in spite of all this 1,500 points up move and also the down move.
Got it.
Right. So I think, yeah, so this is where you need to take a call, and or as I said, if you want to still carry till the end, so you trial your profits. So now your profit is 2,500. So you trial it by another 1,000 rupees or something. So this is how you can manage the iron fly, Vivekji.
Sure. So your capital deployment in this whole exercise was how much?
For one lot, it's a 1.75 lakhs to 2 lakhs.
So 1.75 lakh you are putting to make approximately 2,000 rupees, right?
Yes.
Per week.
Yeah. So basically my target is 1 to 1.5% return. So per week.
Okay.
So in a month you get, about 4 to 6%. You will have some losing weeks, but on an average you will get a 3%.
Sure.
But also, let me tell you, sometimes when I'm getting a, not every week will be the tough week like this.
Yeah.
So if I'm getting a 3,000 profit, I'll start trailing. There were days I booked even 5,000 profit also. Even this week, example, Monday I initiated a position just before the budget. So per lot, I have booked a profit of 5,500 rupees on Tuesday itself. So that was a budget special with IV, IS and all.
Perfect. So Reddy, this was super helpful. I think you still have one last slide. So let's go through that slide. I hope you will share the presentation with us.
Yeah. Yes.
So if you share the presentation, we'll give people link to download the presentation.
Yeah.
Just a minute. I have a call. So the person has joined actually. That's a peril of Zoom call. But anyways, it was great talking to you. It was really helpful. I think this is worthy of a one full webinar. People charge for these webinars, and you have given this content, a very elaborate content, free of cost to our learners. So thank you so much for being such a generous contributor to the learners. And I hope you get the enough karma advantage out of it and you grow further in your journey as a successful trader. Thank you so much.
Any queries, I'm happy to answer them, in a Twitter or any platform.
Of course, we will give you a Twitter handle to our learners below this video so that people can follow you, and please be in touch with Reddy if you need any information. Thank you.
Thanks.
Thank you, Reddy. Thank you so much.
Bye.
Take care. Yeah.
Bye.